You're listening to The Whole Truth, a Resources Rising Stars podcast.
Hello and welcome to this episode of The Whole Truth podcast. I'm Paul Armstrong. I have to say I think this is one of the best episodes we've done of this podcast. Not due to my contribution by any means, I hasten to add, but because the talent on this episode is Ken Brinsden, known to many of you as the former managing director of the great Pilbara Minerals, now living in Canada, advancing his new company and project at Patriot. Some of you may recall that Patriot's lithium discovery in Canada is absolutely spectacular. It drove the share price to levels that are about 4 times higher than its current price. It's come down with the rest of the sector. We all know that story well. The question is, as we put to Ken, has the price bottomed? Has the lithium price bottomed? Is this a great opportunity for investors, or are you catching a falling knife? Ken provides some great insights into how good this project is, why it would make money even at these depressed prices, which by extension means it will make a killing should the price go anywhere near previous levels, even if it were to go up by 50%. The economic study just put on the table shows this project will still make plenty of free cash flow. What's really interesting is Ken's insights into the lithium market and particularly where the North Americans are going in terms of EVs and batteries. He has great insights into the Chinese way of thinking, where they're going, and how America plans to pull them on, and the role that Patriot will play in developing a vertically integrated supply chain from the mine to the EV to the US consumer. This is an episode you can't miss if you've got any ideas about making money out of what could be one of the great turnaround stories of our times. Ken, the Patriot share price has come off heavily along with the rest of the lithium sector in recent months. I mean, it's probably trading at circa 1/4 of its highs in the glory days. No orphan there by any means. I suppose the question for our listeners, Ken, is are they catching a falling knife, or is this a great opportunity, generally speaking?
Yeah, thanks for pointing that out, Paul. Look, it's a confusing time for investors, isn't it? But it's equally true that we've seen this before. You know, those that have been following the lithium game will remember the downturn in particularly 2019 and 2020. And it's a rocky road. It's a volatile market. It's a nascent market that's still growing, and that creates leverage in the system. So clearly we're going through one of those cycles, and it's the same old story, Paul. It's all about China. China is the largest of the lithium raw material consumers, at least at this point in time. And as a result, you know, they in effect define the supply-demand balance, and they've done a good job inspiring some unusual supply in the last couple of years, and that's clearly affected as price has been a determinant of price. But demand conditions are still really good, and the market is still clearly growing, and has a lot more growth to occur over the balance of this decade. So is it a falling knife? My view is we've probably approximated the bottom now, and you can never be definitive about that, but it feels like it. And I think probably the next surprise is, in fact, to the upside. And again, it's all about China. So China's built a lot of battery making capacity, especially in the lithium iron phosphate cell area. They're lowering the cost of those cells. That's growing the addressable market quickly. So it feels like that at some point in time they're going to come back with another wave of demand, and we can expect the price to bounce from there.
Of course, it seems like a harsh question, Ken, to say, you know, the stock's come off heavily, as has the whole sector, as I pointed out. But from an investor's perspective, you know, our listeners love to hear about companies that are going great guns. It's great to hear about record high share prices. But, of course, there's a lot more opportunity in a company that's been heavily sold off, provided it, you know, the outlook is better than the past. And that's why I cut to the chase there about, is it a falling knife or an opportunity? I mean, you've just put out this preliminary economic assessment on the project, and I noticed that you say this project will make money even at current prices.
Yeah, that's right. It's a really defensive project, and it has all the hallmarks of being a great project for the times, because the combination of potential scale and the grade is really what defines it being a great project. So we've pitched our PEA to demonstrate that it's a really large project. In fact, at the time it's in full production, we'd estimate it to be, you know, well within the top 5 globally.
Now, just have a look at that, because you talk about, you divide this into stages, don't you? Just take us through. How do you arrive there, and how will it compare?
Yeah, well, for those of you that know my history, you'll appreciate what we did at Pilbara Minerals. We staged the development such that you could use the operating cash flows from the first stage to fund subsequent expansion stages. And of course, that's exactly what's happened at Pilbara Minerals. And it's a really similar logic with Patriot. Stage 1, in itself, it's a relatively large project. It's 400,000 tonnes of spodumene concentrate. But our intention would be to expand relatively quickly. That's what the PEA base case does, to double production to 800,000 tonnes of spodumene concentrate, again using the stage 1 cash flows to fund the stage 2 development. And it is a really logical way to roll out the capital and grow your presence in the market.
It does beg the obvious question, though, why not go straight for stage 2, go to 800,000 tonnes? That, I think you said, would make it about the 4th biggest producer in the world. Presumably, it's like building a house. Ultimately, it would be cheaper to build the whole thing in one go. You'd get lower unit costs if you're doing 800 rather than 400,000. Why not go for the doctor?
Yeah, I take your point, mate. I guess the balancing objective is to say that you don't have to raise all that money from day one. And it's equally true that we're thinking about our project as being key to underwriting a new supply chain in North America or in Europe, or both. And in so doing, you have to match your mine capacity to the chemical capacity. And it's just not logical to have built that bigger scale in your first bite. But to eat the elephant in chunks, that makes sense. And that's essentially what we're looking to do.
So you look at some of those numbers, firstly on the rather unfortunately named P, as they like to call it in North America, the preliminary economic assessment. The return on capital, the payback period is pretty sharp.
Yeah, it's a fantastic project, Paul. There's no two ways about it. It is one of the great development projects in the lithium raw materials world. I think the PEA shows that clearly. And it's a defensive project. You know, you can argue it's a project for the times because it's got this subset of the resource that's really high grade. We've previously termed it the Nova Zone. It's incredibly high grade. It's got about 22 million tonnes at 2.1% lithium.
Put that in context for us. 2.1% of the high grade zone. How would that compare to what's being spewed out of Pilgangoora in the Pilbara today?
Yeah. Well, a lot of the WA spodumene is in the category of sort of 1.1 through to about 1.3% lithium, and certainly Pilgangoora is like that, maybe about 1.2.
So it's a genuinely high grade project by any comparison.
In total terms, for production over the life of the mine, it's about 1.35%. But in this Nova Zone, you've got the capacity to mine, in our case, the proposed underground, 2.1% lithium, including stopes within it that are 3.5% lithium.
So it gives you that high-grade starter project that generates the strong payback, the quick payback period.
That's right. So we've deliberately used a hybrid mining strategy, partly underground, partly open pit. The underground is targeting the high grade, and the open pit, which, by the way, is very low strip ratio, so 3.7 to 1, that would be amongst the lowest.
But you're going to go straight into the underground, which is a bit of a turnaround for the conventional approach in mining, isn't it? Normally start with the pit, dig your way underground.
As presented in the PEA, it's actually the open pit first, followed by the underground. However, in the trade-off studies that we'll take into the feasibility study, we'll have a look at reversing those, and the logic is to bring forward that high grade.
So it's all about getting this rich, high-grade, rapid payback operation underway. But you make a very interesting point there. We've got to take this apart. There's a lot to it, Ken, that 400,000 tonnes a year is probably about right-sized, if you like, for your target market. Now, this brings us to the question, who are you selling it to? Presumably the Western world.
Yeah.
So your old friends in China at Pilbara aren't on your list.
Definitely lots of friends in China, as we have friends in Korea and new relationships developing in North America and Europe. But yes, it's true. First prize for our project is to continue to underwrite this new Western supply chain. And it's a really important objective, both for industry and arguably for governments now as well, who worry about geopolitical risk, in these critical mineral supply chains. So So we feel we're ideally placed to help underwrite those new supply chains because we've got this massive project. It's very defensive and high grade and lasting for decades. With that as a backdrop, you can use it to help underwrite the billions of dollars of investment that are required for this new supply chain in the West.
Now, that's a very geological specific approach, isn't it? It's a bit of a bite size is right size, if you like. You're saying that we'll start at 400,000 and build it up as the industry grows in North America, whereas presumably 800,000, if you went straight to stage 2, it would get lost in the wash in the sales to China. So that would be an option if you wanted to target the Chinese market. But presumably you're taking a longer term view here, one that's more in keeping with the sentiment in the US, you might say, at the moment, and say we will play a key role in helping to foster development of a lithium battery / EV industry in this continent.
Exactly. That's exactly right, Paul. The last decade or even 15 years was all about growth in China. Or you could argue North Asia, if you include Korea, because they're a big mover in the battery world as well. And we think the next decade is all about North America and Europe and emerging demand there. And clearly industry is focused on that objective too, because as much as equity markets are fretting about the lithium world today, actually the industry itself in lithium is intensely focused on trying to work out how to build this new supply chain, and we're happy to be a part of that conversation.
So how far behind is the Western world in this game? Because as I just said, 800,000 tonnes a year, your stage 2, you would be able to pump into Asia, China and Korea and the likes in a heartbeat. It would hardly move the dial. So you're saying we'll right size it to 400,000 tonnes. That would suggest to you that the Americans are a long way behind the Chinese.
There's a big problem here, Paul. China's dominance in the industry is just about all complete. And it starts with value-added chemicals and makes its way now all the way through to cars. It might surprise you to hear today in China, it's now cheaper to buy an equivalent EV to an internal combustion engine car. They're the first economy in the world to do it. They've done it. They've done it in the last 12 months. So if you're the average consumer in China, of course you naturally want to buy an EV now because it's cheaper. And the West is going to get there. In fact, they'll have no choice. Otherwise, all of our Western car companies are going to shrink to nothing as China consumes their markets. So definitely catch up. Can it be achieved? I think the answer is yes. And where we need to compete is in the world's best resources. Now, China's dominance is all about chemicals, value-added chemicals and cells. They don't have a natural competitive advantage in the resources themselves. However, the West does. We have some of the world's best projects, and of course we would put our Shakachuanan project well and truly in that category. So what do? To compete with China, you get the best projects, the lowest cost projects into the market, and you match it with the key chemical capacity. That's the way to compete with China.
So how does America close this gap?
They're deadly serious about it, Paul. And there's now really serious investment being put into projects that are going to help them compete. The Department of Energy, the Department of Defense in the US is now motivated and actively spending money in the lithium-ion battery supply chain, including in raw materials. And Canada itself is motivated to incentivise critical minerals industries. So we've noted in our PEA taking advantage of tax relief that's now part of the incentive package in Canada. It's not insubstantial. In fact, it covers about 200 to 240 million Canadian of our capex. So very real incentive to create this new supply base and new supply chain. We think we're well placed to take advantage of that.
These things don't happen overnight, Ken, as you know. It's not going to be a case, though, that by this time next year, the North Americans are going to be able to beat the Chinese at this game, is it?
No, it's a longer term play, but it's now all about the survival of their car industry and arguably the new energy industry as a whole. China's dominance in this sector is pretty much complete.
So what role will tariffs and other economic blocking measures, to be frank about it, play in trying to stall the progress of the Chinese and the North American market while the Americans play catch-up? That's obviously the game.
Yeah, no, I think there's every chance if it doesn't grow from here, the idea that the tariffs will try and protect their industry, but I don't think it changes the end game. The end game is still that the car industry is going to have to change and compete. Otherwise, China just continues to keep consuming their markets. You can see it on the streets here in Australia. China's selling EVs to us like hotcakes because they're well priced and they're a quality product. The West has to make sure that they catch up for fear that otherwise their Western car makers, die.
So returning to your project then and the outlook, what happens next? You've outlined a case that says, hey, this thing would make money, not a lot of it, but would be cash flow positive at what is widely accepted to be a very depressed price, increasing amount of commentary suggesting that it is at or close to a bottom. If you're making money there, presumably if the price does go for a run, you make really big money. What do you do next?
Yep, we're continuing to de-risk the project, Paul. It is one of the great ones globally, so we're motivated to keep progressing the project and its development. That takes us into a feasibility study. We keep drilling. We've got more exploration to do. We've outlined an exploration target that shows the sum of existing resources, approximately 140 million tonnes, and the exploration target, we're looking at 300 to 400 million tonnes in the future. So it's one of the great ones, really big project, and therefore we're going to keep pushing it and progressing it. I guess the other point I'd make too is, a lot about a project is where you're doing it. And that's been one of the competitive advantages, in Western Australia. Pilgangoora is a great example. But Quebec itself is another great mining jurisdiction. And, I've been getting a dose of commentary on mining in Australia, having been back here for a month or so now. And some of the issues that are emerging about the development of new mines. It's obvious you don't want to be building a mine in New South Wales, Australia. Well, I can assure you, Quebec is not like that. It's much more like Western Australia. It's a great mining jurisdiction, diverse mining economy, underground, open pit, precious metals, diamonds, you name it. The list goes on. Nickel, and of course lithium, and therefore we're happy to be a part of it. It's a great jurisdiction. You can reasonably expect if you're a competent company, well engaged with the First Nations, the Cree in our case, that you're going to get your project approved, and that's our expectation. We'll continue chipping away at it.
So here's the question. Would you expect Patriot to still own 100% of this project at the time it turns the first sod?
Well, that's a really good question, Paul. I can only answer that by simply saying it's our job to be responsible in the development of both the company and the project, and continuing to de-risk the project. And that's going to be the strongest value add for our shareholders. As to what others might choose to do, we can't control that. But what we can control is to continue to progress the project sensibly and in a sustainable manner.
So you'd be open to a deal, presumably a vertically integrated style deal with some sort of North American, ambitious battery chemical type company, or even someone in Detroit who's going down this line?
Yeah, there's all that engagement going on, and we're happy to have those discussions because, as we alluded to earlier, we want to be part of that new supply chain, and we think that's ultimately the first prize for our shareholders. So we'll keep working on it.
So what do you make of the announcement this week that Ford said that it's going to stop its plans for an electric SUV? How does that sit against a backdrop of North America trying to beat the Chinese?
Yeah. No, it's interesting what's happening in the market because actually Ford also has had huge success in growth in EV sales. So it's a bit perplexing to me. I understand that it's challenging to change. Any business having to change, it's hard. But in the face of the competition that's emerging from new players, Tesla would be an obvious example. But even China itself, the legacy car companies are going to have to keep competing. There's just no avoiding it now. Eventually, EVs in the West are going to be cheaper than internal combustion engine cars. And I've got to say, I don't think it's actually that far away. Have a look at what's already happened in China. It's now cheaper to buy an EV than it is an internal combustion engine car.
Is that partly as a result of subsidies and tariffs and the like, or is that just pure, genuine economical comparisons?
No, that is now on a like-for-like cost basis. So
they can make a combustion car, or rather an EV, for the same price as a combustion car.
Cheaper. It's now cheaper. Yep. And it's principally driven by what China's done to lower the cost of the batteries. That's the main component of cost. And that's the area where they've made significant gains. Some of it in economies of scale, some of it in lower material price inputs, and some of it through margin.
But the Europeans and the Americans say they're not even close to that, aren't they? I mean, I've seen articles out of Britain talking about the cost of producing an EV in Europe is still astronomically high. So they obviously have a long way to go before they get the cost base to an even keel.
Yeah. Some of it's about the battery technology too, though, Paul. So China's preferred a lower cost cell. It's called the LFP cell, so lithium iron phosphate battery. And they've gone hard on that particular cell, and that's a materially lower cost cell.
But what's the downside of the cheaper, lower cost? You get what you pay for, I would have thought.
Yeah, they're less energy dense. The implication is that you might have less range or less power at your disposal. But for most EVs, that's actually not that big a deal, and you can, if you've got a city car or you're not necessarily after a huge amount of range, then those cells will do the job just fine. And that's what China's chosen to deploy, and they've been very successful at it.
Right. So that's been a key player in bringing the cost down to combustion engine levels.
Yeah.
Now, obviously in America, where they've long had a love affair with big V8s and the petrol guzzlers and horsepower and, brute horsepower, selling to the consumer over there the idea that you've got a weaker battery with less range, less power, that's going to be harder, I would have thought, than selling that to the average Chinese motorist in Shanghai.
Yeah, my view would be whether it's a high nickel cell or an LFP cell, it'll be horses for courses. Those cells will make their way into the right subset of the market to support the consumer demand. And if you're after longer range and if you're after more power or even faster charging in certain circumstances, then you'll get the high nickel cell. But equally, the LFP could be a solution for city cars, especially for static energy storage.
So do you envisage the Americans going down this route of this cheaper, less powerful, shorter lasting battery?
Yeah, I think there is some logic in that.
In some parts.
Yeah, exactly. Yeah. Not everyone's going to want the big, F-150 Lightning. But
so it'll be the equivalent of the Corvette and a Corolla.
Exactly.
They'll both be on the showroom floor.
Exactly. In the same way that you do with an internal combustion engine car. You're spot on there, mate.
Yeah. So it will be, as you say, horses for courses.
Yeah.
Horsepowers for courses.
Exactly.
Now, I suppose we get to the pointy end of this conversation then, given the outlook for the industry in North America and your plans to play a key role in it, Ken, who works best for you in the election, Kamala or Trump?
No matter what your politics, I actually think in the US the conclusion pretty quickly becomes the same, and it's the broad economic power of China that you're tackling, and I don't think it matters whether you're a Republican or a Democrat in that respect. You basically come to the same conclusion: we have to compete. And that's what motivates your response. So I'm not overly concerned really about the direction that the election takes. I think the conclusion is broadly the same. The US will continue to work on changing their supply chains so that they are not so reliant on China. And I want to say that that's broadly supportive to the development of our Shakajuwanan project. I think that's going to be required to help, these big projects that are the right combination of scale and cost and longevity are going to be required to help underwrite that supply chain. So when we think about where our funding comes from, for example, yes, I think industry is going to be involved, of course, and government, I would say, is going to continue to incentivise, using the example I highlighted earlier, tax relief in Canada. That's part of inspiring the critical minerals supply chain. So there'll be more things like that help support our project's development over time.
So just finally, returning to Patriot's project, Ken, the numbers out of the P study are absolutely fantastic, but cynics would say that's based on a assumed lithium price that's circa double the current price. Now, yes, at the current price you do, as you say, make money, but the really big returns obviously are kicking in when the price doubles. What has to happen to get that price to double?
This is also a really interesting question, Paul, and I think underestimated by most analysts in the Western world. And again, it's all about China. So I mentioned the LFP capacity in China being a key to their market. Now, it turns out that today they grossly underutilise what they've already installed. China has a history of doing this, and the solar industry or the solar panel industry would be a good example. But what it does is it creates leverage in the market. So let's imagine that the cell cost continues to decline at a rapid pace. So LFP cells in China have halved in the last 12 months. Let's say they continue to get cheaper. What happens is that the market within which those cells can be placed grows. Where do those cells go? Well, they go to city cars, like we discussed earlier. They go into static energy storage. The box with the cells in it on the side of your house to capture the excess solar. And they're becoming much, much more competitive because of the speed with which China is lowering the cost of those cells.
So the size of the market is simply growing.
And I think being underestimated by analysts in the West. If China chooses to switch on the underutilised capacity, of course they're going to come back and there'll be another wave of raw material demand, and that's when you'll see the price swing. And Western analysts say that's not happening till later this decade. I honestly do not agree with that thesis, and I think China comes back to market probably faster than just about everybody assumes today.
You talk about how good the project is. It does seem like a long time ago, but it was only sort of 12 to 18 months ago that Patriot stock was trading at circa 4 times the current price, and it was the talk of the town, the talk of the share market. And the drilling results have been absolutely nothing short of spectacular. No one would say anything different. But the fact that the stock got so high reflected the spectacular nature of the discovery, the widths of the mineralisation, the grades. They were things that every other lithium explorer could only dream of. It was the envy of every lithium company on the ASX at the time. So obviously the fact that shows that is reflected in the idea that you can make money at what is a depressed price. But it does show, coming right back to our original question here, Ken, is it a falling knife or is it an opportunity, that anything of a half reasonable price, even if the price were to go up 50% and not double, the returns for this project based on this study and the results that were being achieved would have to be substantial.
Yeah. All of that's true, Paul.
Yeah.
I can only agree. So, yeah, I think again, I make the point, the leverage in the market to price is pretty incredible today. And I think China is the key influence.
And if this project were not to make money at the current price, you'd sort of say, well, what project would make money? In which case, as the economists like to say, it's an automatic stabiliser, isn't it? There's a point at which supply falls out of the market. If this project's not making money at this price, plenty of other projects will be losing a truckload of money and have to shut the doors.
Yeah, China's, again, the big influence there. They've started a lot of new production in the last 2 or 3 years, a lot of it coming domestically in China. Africa, it's typically going to be higher cost. And a lot of it's lepidolite, isn't it? That's right, low grade, yeah. And as much as China might want you to believe it's low cost, it's typically not. And what that means is it's typically going to be the first to fall out of the market. West Australian spodumene supply hasn't slowed down, not materially, in the last year. Prices come off, but it's kept going to China. So it's telling you that it's the right combination of cost and quality, and it's probably the other stuff, ex-Western Australia, that's falling out of the market.
It's almost so simple, Ken, as to say, if the Patriot project isn't making money, supply is going to nosedive.
Yeah, exactly.
They go hand in hand.
Yep, exactly.
Yeah.
And it's one of the few projects where you can actually cut your cloth to match the economic conditions of the day because of that really high-grade subset.
Ken, look, we've taken enough of your time. It's been a fantastic chat. I'm sure our listeners will love this. It's an opaque market. It's hard to get an understanding of what's really going on at the coal face or the lithium face, as the case is. And people, I think, really value your insights. You're one of the people who really is involved in the market all over the world. You're now a resident of Canada as you advance this project, but back in Australia for a couple of months, and you're coming over to the Gold Coast on the 3rd and 4th of September to talk to people over there.
Yeah, looking forward to it, Paul.
So anyone who's coming to the conference, please come and avail yourselves of the opportunity to have a chat and a drink with Ken, and of course the presentation by Ken at that conference, along with all the presentations at that conference, will be live online. So there for anyone to listen live or to watch it at a time of their choosing. Ken, thanks very much for your time. We'll see you on the Gold Coast.
Pleasure, Paul. Thank you.
You've been listening to The Whole Truth, a Resources Rising Stars podcast, produced by Resource Media, hosted by Paul Armstrong for Reed Corporate. Please note that Reed Corporate does not provide investment advice, and investors should seek personalised advice before making any investment decisions.